If you want the truth about how systems fail, don't look for the day everything explodes. Look for the day everything goes quiet. Because modern collapse doesn't always arrive with sirens and smoke. It arrives as a delay that no one can explain. A market that should have buyers, but suddenly doesn't. A bank that should have cash, but suddenly can't move it. A nation that should be stable, but suddenly needs a lifeline in the middle of the night. In part 1, we mapped the machine, how America built a financial engine powered by debt, leverage, and confidence. In part 2, we followed the cracks, how stress hides in the plumbing, how liquidity can vanish before the headlines even wake up. Now, in the final chapter, we answer the question that makes people uncomfortable. How close did the United States come to a full system failure? Not a recession, not a bad quarter, a breakdown of the pipes that keep money moving. And here's the twist. The closer you look, the more you realize. The scariest moments weren't the ones on television. They were the ones that were fixed fast enough that the public never saw them. So let's talk about the silent breakdown, the near collapse that almost happened, the one that left no crater but changed everything. After 2008, the story became neat and comforting. We crashed, we learned, we reformed, we recovered, and on the surface, it looked true. Markets rose, home prices eventually stabilized, big banks posted profits again, unemployment fell over time, the crisis became history. But here's the first hook you need to hold on to. Recovery is not proof of health. Sometimes recovery is proof that someone injected enough emergency medicine to keep the patient walking. Because after 2008, risk didn't disappear. It relocated. Household leverage cooled, but public debt expanded. Banks faced tighter rules, but shadow finance grew larger. The system became less visible, not less dangerous. Think of it like water. Block one river, and the flood doesn't stop. It finds another path. Sometimes underground, sometimes through pipes you didn't even know existed. And the American system after 2008 became exactly that. A complex network of pipes, backstops, workarounds, and faith. Faith that markets would stay liquid. Faith that someone would step in. Faith that the dollar would always be demanded. Faith that the US Treasury market would always be the deepest pool on earth. And as long as that faith holds, the system feels indestructible. But faith is not a balance sheet. Faith is not collateral. Faith is not cash at 9 a.m. when everyone wants out at the same time. When people hear collapse, they imagine one of two images: a 1930s-style bank run with lines around the block, or a sudden stock market freefall like a movie montage. But modern near collapse looks different. It looks like this. Payments slow down. Short-term funding rates spike. Bid-ask spreads widen. Counterparties stop trusting each other. And the safest assets on earth suddenly trade like they're not safe. This is the key idea. A financial system doesn't need to die to fail. It just needs to freeze. Because the modern economy is a motion economy. Money needs to move. Credit needs to roll over. Treasuries need buyers. Repos need lenders. Payroll needs to clear. Bills need to settle. If the movement stops, even for a short window, the damage can be existential. So when we say the US system nearly collapsed, we don't mean people were looting grocery stores. We mean something more technical and arguably more terrifying. The mechanisms that turned trust into transactions were seconds, hours, or days away from seizing. And once that plumbing breaks, it doesn't matter how rich the country is on paper. On paper, everything is fine. In practice, nothing clears. In part 2, we talked about the plumbing, and now we're going to live inside it. The plumbing is the hidden architecture of modern finance. The repo market, money market funds, clearinghouses, treasury auctions, short-term credit lines, interbank lending, collateral chains. Most people never see it. but it's where the real panic begins. Because it's where institutions measure each other's trust. In normal times, the plumbing is boring. Overnight loans roll over. Collateral gets posted. Trades settle. Liquidity flows. In stress times, the plumbing becomes the battlefield. Not because one company is weak, but because no one knows who will be weak next. And when uncertainty rises, the system's default setting is not generosity, it's self-preservation. That's when lenders ask for more collateral. Borrowers scramble to find it. Assets get sold, prices fall, more collateral is demanded, and the cycle tightens, like a noose. This is why crises accelerate. Not because everyone suddenly becomes irrational, but because the rules of survival turn rational behavior into systemic damage. Here's what most people never hear. There were multiple episodes after 2008 when the system showed it could still choke. Moments when liquidity thinned out, when core markets turned fragile, when policymakers moved quietly, fast, and big. The scary part is not that these events happened. The scary part is how quickly normal can turn into not normal. When confidence slips. Because the US system depends on an assumption that almost no one challenges. That there will always be a buyer for the safest assets. That treasury markets will always function. That the dollar funding market will always clear. But the system's near-collapse moments were often linked to a single theme. A sudden mismatch between the need for cash and the willingness to lend. This is the silent breakdown. It doesn't begin with bankruptcy, it begins with hesitation. And hesitation, in modern finance, is contagious. So why didn't it end? Why didn't the pipes finally snap? Because America has something no other country has at the same scale. It issues the world's dominant reserve currency. It anchors the global collateral system with treasuries. It has deep, liquid markets that investors run toward in fear. And it has institutions capable of building emergency bridges overnight. But that power comes with a hidden bargain. The system survives because everyone believes it must survive. That belief becomes a stabilizer, and the stabilizer becomes a dependency. This is where the story gets uncomfortable, because once markets are trained to expect rescue, they begin to price rescue into reality. Risk-taking expands, not because people are evil, but because the environment rewards it. If you think this is just a moral complaint, it's not. It's mechanics. A system protected from consequences doesn't eliminate fragility. It changes the shape of fragility. Instead of small failures that teach lessons, you get larger structures that accumulate stress. Instead of frequent resets, you get long expansions that end violently. Instead of visible danger, you get invisible dependency. There is a myth that dominates modern investing, that liquidity is always there. People think liquidity is a natural property of markets, like gravity, like weather. But liquidity is not nature. Liquidity is a social contract. It exists only when buyers believe they can sell later, and it disappears the moment buyers suspect they can't. That's why liquidity is most abundant when it's least needed, and most scarce when it's needed most. In calm times, everyone feels safe holding similar assets. In stress times, everyone wants the same thing: cash. And cash demand is not polite, it's urgent, it's immediate, it's synchronized. This is why silent breakdown is such an accurate phrase. It's not a screaming crowd, it's a room of professionals, quietly pulling their hands back at the same time. No drama, no rage, just a sudden absence of yes. Now let's connect the dots, because this is where near collapse becomes a real story. In a modern crisis, the chain reaction often goes like this. A shock hits, uncertainty rises, funding becomes expensive, collateral requirements increase. Assets are sold to raise cash, prices drop, more collateral is demanded, more selling follows, liquidity vanishes, and then even safe assets get dragged into the chaos. Because safety doesn't matter if you can't transact. At that point, the system faces a choice. Let the chain reaction continue until something breaks, or interrupt it with force. Interruption can come in many forms: emergency lending, asset purchases, guarantees, facilities that provide cash against collateral, and messaging that says, in plain terms, we will not let the pipes freeze. This is why, in modern finance, the line between market and policy gets blurry. Because when the plumbing is at risk, policy becomes part of the market structure. And when policy becomes part of the structure changes. Let's zoom out, because you might be wondering why this series was built in 3 parts. Part 1 was about the engine, debt as fuel, leverage as acceleration, confidence as the ignition. It showed how America's system became incredibly productive and incredibly vulnerable at the same time, because high output built on borrowed stability is still borrowed stability. Part 2 was about the triggers, liquidity mismatch, hidden leverage, shadow banking, human complacency, the small stresses that stack until something snaps. It showed how modern crises form quietly and why the public always sees them too late. And part 3 is the conclusion. The system didn't collapse, but not because it was invincible. It survived because it was rescued, reinforced, and rewired. It survived because the backstop is now part of the architecture. It survived because the cost of not surviving was unthinkable. That's the real lesson. Not America is safe forever, but America is too central to fail cleanly. Survival has a price, and it's not just inflation or headlines. The deeper price is structural. Each time you prevent a reset, you extend the life of the structure, but you also extend the life of its weaknesses. Think of it like a building with stress fractures. You can reinforce the beams, you can patch the walls, you can add supports, and it might hold for years. It might even look stronger. But if the design itself creates stress, the stress doesn't vanish. It accumulates in new places. This is why the system can feel stable while becoming more sensitive, not to everyday noise, but to rare shocks. And rare shocks are the ones that matter. So why should anyone outside of finance care about plumbing? Because plumbing decides whether your paycheck clears, whether your mortgage rate spikes, whether your savings hold value, whether your employer can refinance, whether your government can fund itself without panic. And because the silent breakdown doesn't ask your permission, it happens in rooms you'll never see, in markets you don't trade, through pipes you didn't know existed. By the time it reaches your life, it's no longer a technical story, it's a human story. That's why this series exists, not to scare you, not to sell you doom, but to show you how the system actually behaves under stress. America didn't collapse, but it came close enough to reveal a truth people don't like. Modern stability is often engineered, not natural. The system works until it doesn't, and the moment it doesn't, the first sign is not chaos. It's quiet, a hesitation, a freeze, a market that goes blank. In part 1, we built the machine. In part 2, we found the cracks. In part 3, we saw the silent breakdown that nearly ended the story. And if there's one final line to remember, it's this: the next crisis won't look dramatic until it's too late to stop calmly.